Activity ratios show you how productive or efficient a company is on using its assets. These are sometimes called efficiency ratios or utilization ratios. And what you tend to find is that it is an income statement line item divided by a balance sheet line item. So really it's going to be something like sales divided by total assets. Something like that. This presents some problems. You see, the income statement tracks all the financial accounts over a period of time, usually from January 1st until December 31st. Now, a balance sheet does not do that. A balance sheet is a quick snapshot of what's happening right then and there. And so that means that we're really comparing apples to oranges when we divide an income statement item by a balance sheet item. The way to fix this is to actually average your balance sheet items. So for example, if we're going to use sales for 2019 as our top line income statement item on the top of this activity ratio, if we're going to use total assets as the bottom portion of this ratio, then we need to get that from the balance sheet. Well, the income statement number is fine. It tracks throughout the entire year. In order for our total assets number to also track throughout the entire year, we have to look at what it was at the end of last year, December 31st of 2018, and then look at what it is on the end of 2019. And then we have to average those two numbers together, which all you do there is you just kind of add them together and divide by 2. And you can do this over any time period, but really what you're trying to find here is that income statement line item divided by an averaged balance sheet line item. Remember, we use the average because in order to make a balance sheet line item over that same time period, instead of just a snapshot, we have to start at the beginning and start at the end and then average it out throughout that kind of middle area. I hope that makes sense. I know it's a bit complicated, but it's a very important topic because we are going to see a lot of ratios that are looking at income statements versus balance sheet items or cash flow statements, which also span over a time period, versus balance sheet items, which are just that snapshot. So understanding that anytime you're comparing an income statement or cash flow statement line item to a balance sheet account or line item, you have to make an average for that balance sheet account over that same time period, which that means starting at the beginning with whatever the beginning balance was, looking at the end, whatever the new ending balance was, adding those together and dividing by 2. Now, the most common activity ratios are really all around turnover. That's inventory turnover, payables turnover, and receivables turnover. Now, if these sound familiar, we've actually kind of touched on these a little bit when we were talking about the cash conversion cycle. And we're going to touch on that a little bit more as well. But just to jog your memory, receivables turnover is just total sales divided by average accounts receivable. Inventory turnover is just total cost of goods sold divided by average inventory. And payables turnover is just total cost of goods sold divided by average accounts payable. So once again, you're seeing that we have that income statement item, either total sales or total cost of goods sold, divided by an averaged balance sheet account. Inventory, accounts receivable, turnover, you get the idea. To jog your memory on the cash conversion cycle, all cash conversion cycle is days sales outstanding plus days inventory outstanding minus days payables outstanding. And remember, all those days payable stuff, those are actually super easy to calculate. All you have to do is do 365 divided by their normalized turnover ratios. So for days inventory outstanding, just 365 divided by the inventory turnover that you calculated earlier. And for days payables outstanding, it's just 365 divided by payables turnover. And for days sales outstanding, it's just 365 divided by accounts receivable turnover. So it's actually not too complicated. Once you understand and calculate those turnover ratios, it's extremely easy to calculate the days sales outstanding for any 3 of those categories. And then that helps you build out your cash conversion cycle. This was a lot of concepts, and hopefully it's just a jog on your memory of what we had done earlier. But just in case, I do want you to understand that it's really not too complicated. In really theory, you want your turnover to be high and you want your cash conversion cycle to be low. That means that you want to be making a lot of money on the stuff that you're selling, and you don't want it to really sit on your shelves for a really long time. That's at its core kind of what the cash conversion cycle and inventory turnover ratios are really looking at. And for the payables turnover ratio, it's kind of looking at, okay, how long did it take you to pay someone and how often were you paying your suppliers? Your receivables turnover is just the opposite. How long did it take someone to pay you, and then how often were they paying you? And so remember, you want your turnover ratios to be high, except for payables, because it doesn't really matter when you pay people. That's not a huge deal for most investors. And you want your cash conversion cycle to be low. And that's kind of where the payables thing comes in here. Remember, we talked a little bit about how Walmart bullies their suppliers by not paying them always as fast as they possibly could. That's just one of those kind of things that we talked about that hopefully it's stuck in your mind. If it didn't, I suggest going back and kind of watching some of those videos. But if it did, hopefully this is just a really quick recap. Now we have one more activity ratio that's actually very important, and that's total assets turnover. Total asset turnover is really just a very simple way of saying, okay, how much sales are we making based off our assets? And that's can really tell you a lot about a company, about how efficient they are at using those assets, about how often they're using those assets, and things of that nature. Now, you can cut and slice really anything in the asset category, and you can make these exact same ratios yourself. So you can do total sales over, I don't know, your operating assets. You can do total sales over your current assets. You can do cost of goods sold over your current assets. Things like that. You can really get very creative when it comes down to this. All you really have to remember is that really the idea behind these activity ratios is finding out some way, somehow, really is this company productively using their assets? And now this is also very industry based. You see, there are certain industries that will be super high on these turnover ratios if they have low assets. So things like software companies that don't really have a ton in total assets, but they have really high revenue numbers. Those are going to be companies that have super high turnover numbers. Because remember, all you're looking at is kind of sales divided by assets. If assets are low and sales are high, turnover is going to be big. Other companies that have a lot of assets and maybe good sales but not as much sales, like think John Deere tractors, things like that. People that are making big things, Boeing for example. If you're selling airplanes, you're going to have a ton of assets on the books. And yeah, when you sell an airplane, it's going to be worth a lot of money, but it doesn't show you as being as productive as say Facebook would, which is a software company. So that just kind of goes to show you that yes, activity ratios do allow you to kind of compare industries. At the same time though, you need to understand that comparing Facebook to John Deere or to Boeing isn't truly a fair activity comparison. Is Facebook working harder than John Deere? We can't say that because we don't really know. The activity ratios don't tell us that. But can we compare Facebook to Microsoft or Facebook to Twitter? And can we then look at those two ratios and see which one's higher and be like, hey, at that point, the higher ratio does look like they're working harder? Yeah. So inside the industry, I think you can use activity ratios to determine a kind of winner when it comes to productivity and efficiency. But in between industries, all it's really going to tell you is which industries have lower assets on average than other industries. I hope all that makes sense, and hopefully this was a little bit of a recap for you because we kind of touched on a lot of these already. But at the end of the day, just remember that most activity ratios are all about an income statement item, usually sales or cost of goods sold, divided by some kind of asset. And remember, you have to average those balance sheet accounts every time that you use them.